If debt makes people poor, then why do the richest people in the world borrow billions of dollars in loans? Since childhood, we have been taught only one thing: never take a loan. Stay away from debt. But the world's most successful investors, the biggest business owners, and many billionaires, borrow billions of dollars every single year. So the question is, do they know something that most people were never taught? In today's video, we are not going to tell you to take loans. We are only going to explain one thing: why debt becomes a tool for building wealth for some people, and why the same debt traps millions of others in financial problems. If you watch the next few minutes carefully, you might change the way you look at money forever. The biggest financial myth. Most people think debt itself is the problem. But the real problem is not debt, it is how you use it. That is why the same bank, the same loan amount, and the same interest rate can create two completely different results in two people's lives. One person takes a loan to buy a new car. Every month, the EMI goes out. Insurance costs money. Maintenance costs money. But the car does not make a single dollar. Another person takes the same amount of loan and buys a rental property. Every month, the tenant pays rent. That rent helps cover the EMI, and if the numbers are right, some profit remains. Both people took a loan. The only difference was, one bought a liability, the other bought an asset. And this is where the financial thinking of the rich and the average person becomes completely different. Why rich people don't spend their cash first. Now ask yourself a question. If you had $100,000 sitting in your bank account, would you spend all of it? Most people would say, yes, why would I take a loan if I already have money? But an investor thinks differently. They ask, if I spend all my cash today, how will my money continue working for me in the future? This is called opportunity cost. Imagine you have $100,000. Option 1, you use all your cash to buy a property. Now all your money's locked into one place. Option 2, you invest that same cash into an investment that can generate a 12% return, and you buy the property using a loan with a 6% interest rate. If the numbers work correctly, your investment can earn more than the cost of the loan. That is why many investors don't use loans because they don't have money. They use loans because they want their own money to keep working and creating more money. And this mindset creates the first major difference between the rich and the average person. Good debt versus bad debt. Now comes the most important question. Not all debt is bad. So, what is the difference between good debt and bad debt? Bad debt is the type of debt that takes money out of your pocket every month, but in return, it does not create any income. For example, luxury shopping with credit cards, expensive smartphones on EMI, buying a car just to show status, vacation loans. These things lose value over time, but their payments never stop. Now, on the other side, good debt is debt that has the potential to create income in the future. Examples include rental property, business expansion, productive equipment, and carefully researched investments. But here is the biggest warning. Not every investment is good debt. If an asset does not generate income, or if you make a decision without proper research, then even good debt can turn into bad debt. That is why rich people, before taking a loan, don't look at the EMI first. They look at the numbers. And this takes us to the next chapter. They ask only one question: will this debt create income for me? This one question becomes the beginning of their wealth-building journey. The one question rich people ask before taking a loan. Until now, we have understood that debt itself is not good or bad. But how do rich people decide which loan is worth taking? They ask only one question: will this debt create income for me? Notice carefully, they don't ask, "Can I afford the monthly payment?" They ask, "Can this asset pay for its own loan?" This mindset is what separates a consumer from an investor. The cash flow test. Imagine a rental property generates $2,000 in rent every month, and the expenses are $1,600. That means $400 remains every month. This is called positive cash flow. But if the expenses become higher than the income, then the same investment can become a financial problem. That is why rich people don't buy properties blindly. They buy numbers. 4 ways rich people use debt. First method, real estate. They buy property. Tenants pay rent. The rent helps cover the loan payment. And over time, the value of the property may increase. Meaning, one single asset can create cash flow and build wealth at the same time. Second method, borrow to invest. Imagine the cost of a loan is 7%, and an investment has the potential to generate a 12% return over the long term. If the risk and the numbers are carefully calculated, the difference between these two can become profit. But remember, returns are never guaranteed. That is why successful investors look at risk first and profit second. Third method, buy, borrow, die. This strategy is commonly used by many wealthy investors. They buy valuable assets, and when they need cash, they don't sell those assets. Instead, they borrow against those assets. This way, they keep ownership of the asset while also accessing cash. Fourth method, business growth. Many companies do not take loans because they don't have money. They take loans to grow their business faster. If a new machine or a new project can generate more profit than the cost of the loan, then debt can accelerate growth. But this is where the biggest misunderstanding begins. Many people think the bigger the loan, the bigger the wealth. The truth is completely opposite. A loan taken for the wrong asset can make a poor person even poorer. A loan taken for the right asset can help create wealth. Meaning, debt itself has no power. The power comes from the decisions you make with it. And this leads us to the most important part of this video. If debt is so powerful, then why doesn't everyone who takes a loan become rich? This is the question that most people never ask, because debt does not make you rich. Debt only amplifies your decisions. If you choose the right asset, your profits can increase. But if your decision is wrong, your losses can grow just as quickly. This is called leverage. Understanding leverage. Let's understand leverage in a simple way. Imagine you use a loan to buy a rental property. If the property generates higher rent and its value increases over time, your return can become much larger. But if the property stays empty for months or the market goes down, you still have to make the loan payments. This is why leverage works both ways. It can help create wealth, and it can turn a bad decision into a financial disaster. That is why successful investors, before taking a loan, look at 4 important things. First, cash flow. Will this asset generate income? Second, risk. What happens if everything does not go according to the plan? Third, interest cost. Can the return from this investment be higher than the cost of the loan? Fourth, worst-case plan. If the income stops, can I still repay the loan? If the answers to these 4 questions are not clear, they walk away from the deal. Because smart investors don't just look at the possible reward, they prepare for possible risks. A real example. One of the world's richest people, Elon Musk, despite having enormous wealth, has used loans against his assets instead of always selling shares. Why? Because selling shares can reduce ownership, and in some situations, it may create tax obligations. But by borrowing against assets, he can access cash while keeping ownership of those assets. This shows the difference between selling an asset and borrowing against an asset. Why do banks give huge loans? But why would a bank give such a large loan? Because banks do not trust your dreams, they trust your ability to manage risk. If you have stable income, valuable assets, and a strong repayment history, then for the bank, lending money becomes less risky. Meaning, banks don't give loans to rich people just because they're rich. They give loans because their risk is often lower. The biggest warning in this entire video. Many people hear about good debt and immediately think taking loans is the secret to becoming wealthy. But that is the most dangerous misunderstanding. A loan can never turn a bad investment into a good one. But a good investment can make a loan powerful. And this difference separates an investor from a gambler. By now, you understand how wealthy people use debt. But one final question remains. If the secret is not just debt, then what is the real secret? That is what we will discover in the final part of this video. Should everyone take a loan? No. If after watching this entire video, the only thing you learned is rich people take loans, then you have only learned half the lesson. The complete truth is, rich people only take loans that have the potential to create income for them, and that is the biggest difference. Before taking any loan, ask yourself these 5 questions. First, will this loan generate income for me, or will it only create expenses? Second, if my income stops for the next 6 months, can I still pay my EMI? Third, do I truly understand the risk of this investment? Fourth, do I have an emergency fund? And fifth, am I making this decision based on emotions or based on numbers? If the answers to these questions are not clear, then maybe you need to learn more before taking that loan. The biggest lesson from this video. Now, imagine this situation. 2 people, on the same day, take the same amount of loan from the same bank. The first person buys a brand new car. The second person buys an income-producing asset. 5 years later, both of their loans are almost paid off. But the first person has an old car. The second person has an asset that is still generating income. Both people took a loan, but only one created wealth. Why? Because the loan did not create the difference. The decision did. And this is the most important line of this entire video. Debt does not make you rich. Debt does not make you poor either. Debt only magnifies your thinking and your decisions. If your mindset is focused on consumption, then debt can make you poorer. But if your mindset is focused on building assets, then the same debt can become a powerful tool for creating wealth. The next time someone says, every loan is bad, don't argue with them. Just ask one question. If debt was always bad, why do the richest people in the world borrow billions of dollars every year? Maybe the real question is not about debt. The real question is your debt working for you, or are you working for your debt? Because this one question can change your entire financial life. If you enjoy videos like this, where complex financial concepts are explained in the simplest way, then make sure to subscribe to Acorn Theory and tell us your thoughts in the comments, because our goal here is not just to make money. Our goal is to understand the rules of money. See you in the next video.